this interview series where we bring you the minds behind the management of your money. Each week, we delve into the strategies, philosophies, and the ever evolving dynamics of financial markets through the eyes of seasoned professionals. And today, joining me and my colleague Chirag is Atul Bhole, Fund Manager at Kotak Mahindra Mutual Fund. Welcome, Atul.
Thank you, Ruchira. Thanks for having me on your show.
Thanks. First up, Atul, can you please share with our viewers what initially attracted you to the world of financial markets?
Actually, attracted in the sense was not, I would say, is not a good word, because I came into this market or landed into this market by elimination process, I would say. After 10th, I didn't actually wanted to go into the science stream, so ended up choosing commerce. And while pursuing my chartered accountancy, I realized that that's what I cannot do for lifelong in terms of audits and taxation, etc. So I ended up in a B school. And while pursuing finance there, I realized that I may not be able to do banking or a company sort of finance officer kind of role for my life. And at that time, actually, there was a professor in our college who was sort of dealing in the market as well. And he's an investor in the market. And that's how I sort of started taking interest in the market, and then one by one, I think things started falling in place, and I landed up here.
You started with the SBI in a treasury department, and then you moved to Tata Mutual Funds, and it's been a long journey of around 18-20 years in the financial markets. So what were the key lessons learned during this period of time which is helping you in the fund management business as of now?
I think all through this journey, I was very lucky to have good mentors at various points of time in my career. So while during in SBI also, I got a very good experience, because in 2005 to 2007, there were a lot of IPOs coming into the market. That was a bull phase of Indian capital market. And I could get opportunity to evaluate those IPOs. And at the same time, I used to have a lot of support or sort of a perspective from the bankers from within SBI about those companies, and that helped me a lot during that initial phase of my career. That I sort of getting a very good perspective from experienced bankers about the promoters, about the businesses, and all those things. And then when I shifted to mutual fund industry, even in my first job in the mutual fund industry, I was sort of lucky to have very good mentors, and the learning from that job is basically in terms of look at the company where you can hold on to that company for a long period, and basically if for any reason the correction is deep into that stock, whether you can accumulate that stock in that correction also. So only go into those kind of stocks where you can sort of develop full conviction, and then after taking that conviction, you should have you should develop the ability to hold on to that stock for long. I think those kind of things which sort of help me broaden my perspective, as well as sort of increase my investment horizon. I think those two things are very important, which I learned over this period.
All right, Atul, could you describe your investment philosophy and, what kind of stocks or market conditions capture your interest the most?
I think in terms of investment philosophy or frameworks, my investment philosophy basically tilts towards buying good quality managements. I would not say business, I would say management first, because I know businesses are stressed upon. But I think in Indian context, we have seen that and learned over a period of time that managements or promoters is what is very important. I think businesses can be built or destroyed, but by good or bad management. So management, staying with good management for long period of time, I think that is very important. And obviously, identifying good businesses or establishing sort of growth potential for those businesses is important, but I think the starting point has to be management. And when you look at good management, business or growth potential, obviously sometimes you have to pay premium valuation for some businesses, but I think over a period of time that actually pays, because on one side you sort of participate in the compounding of those companies and businesses, and at the other side you also avoid a lot of accidents or drawdowns, because when you start with good managements and good companies, obviously the chances of losing big time reduces. And I think the investment alpha can be created in two ways. One, obviously, capturing the upside in a decent manner, but more importantly, I think reducing the drawdowns or protecting the downside is also very important in creating sort of medium to long term alpha.
Atul, can you just elaborate on, how do you choose a good management?
Yeah. So again, I mean, it's sort of a subjective thing, and we do have a lot of cumulative experience while working with mutual fund setup, or for that matter any team. And having spent 18-20 years in the market, we have sort of observed the promoter groups and managements in terms of their behavior of managing businesses. And also we do channel checks in terms of integrity and etc. etc. 2-3 things I would say which I look at while judging management is basically, first is capital allocation, how they have allocated capital within businesses, or even at this in the same business, at what point of time the capital allocation has happened. That is very important to sort of maintain the growth rate, as well as limiting the drawdown and maintaining the return ratios, which ultimately adds to the value. So that is very important. Secondly, I think another way to look at is basically how the management has managed the cycles of greed and fear. We have seen multiple times that during good market phases or during good economic phases, management do tend to make mistakes in terms of over allocation of capital in the same business, in terms of expansions, or wrong capital allocation, in the sense doing acquisitions in the peak of the cycles. So in both cases, ultimately they'll end up in troubles. At the same time, we also need to have management which sort of don't invest in the business when the market or economy is not doing well at all. We have seen those examples also, that they sort of gone into sort of hibernation. We didn't invest in the business, and when markets sort of come back, the business is often not able to monetize the growth part, because the underinvestment has happened. So I think these are 2-3 ways I would say: capital allocation, the way they have managed the cycles of greed and fear, and apart from the typical things like integrity and all those things.
Coming to the stock selection, when evaluating a potential investments, what are the key factors you consider a stock being a compelling buy?
So I think some of that I have already sort of answered while giving the answer to the framework part. So while in terms of stock selection, again, the same things come into picture, basically management, business, and growth. Obviously, some more important, important or more analysis of the business part or the growth part. I think when you come to business, I think apart from the typical factors like cash generation and ROE, etc., I think the moat of the business in terms of particularly in terms of market share is very important. I think maintaining market share or increasing market share is very important, and that actually creates value over longer period of time. I think market rewards market share gains or stability in a much more sort of rewarding manner than any other thing. So that is about business. And second, about establishing the opportunity set or the growth potential is also very important. A management might be very good, and the business structure or the industry structure might be also very good. But if the opportunity size is not very big, like if in a $3-4 trillion economy, if that industry size is just 5-10,000 crore, then it's then there's no point beyond some point to sort of keep on delving into those kind of industries or businesses, because ultimately we have to look at long-term picture, how the industry will grow, and depending on industry, the company can actually create wealth. So I think in terms of stock selection, those things go. And lastly, in terms of valuation, as I mentioned, all these things, you would have noticed that I didn't start with valuation. For me, the management comes first, and then business and growth in that order. Valuation comes last. And as I said, if all these things are established in terms of good practices, in terms of management, business, and growth, I'm sort of willing to pay slightly higher valuation to those companies, because that premium or etc. is taken care by the quality of the business and the compounding of earnings. And it also helps us in terms of avoiding the accidents or drawdowns. So the starting point is management and the ending point is the valuation. Obviously, it's not that I will buy any company or stock at any valuation. Obviously, there will be some rules or etc. to follow while taking those decisions, but that is not the binding factor, I would say.
One more thing, just wanted to add on this point. What kind of markets or situations you really like, to invest in at that, which particular excites you?
Yeah, I think a normal market, or I would say slightly volatile market, suits me a lot, because in a very bullish kind of setup also, often mistakes happen in terms of chasing the momentum where the fundamentals are not up to the mark. I think the current market setup is like that, where a lot of stocks have done well. While fundamentals might have improved by some extent, the stocks have done a lot basis other factors like momentum or narratives or stories. So I think that kind of market, even while maintaining the discipline and patience and all those things, some mistakes tend to happen, and we try to minimize those kind of mistakes. But this is a competitive world, and relative return game, etc. So some mistake happens. So I think this is also not the market which I enjoy, because mistakes can happen, and generally we have seen that such kind of market end in a very concerning way, or not in a very happy situation, and that time the drawdowns can be significant. So I think this kind also one has to be sort of cautious. And actually, I would say a typical normal market or slightly volatile market where not lot of ups and downs are happening, I think that is a good market, and that suits actually to my framework or style in terms of buying good quality compounding businesses run by good management. I think that is the market. I know some people want, or some investors like a very sort of bear market, or market where they fall to sort of 10, 12 B. But I think I don't want those kind of situation also. Because in those situations, it is very difficult to establish the business potential or how the businesses will come back in many cases. And we might invest looking at valuation, but sometimes because the market at those periods of time would be such that businesses would go to those levels because of issues like over leverage on the balance sheet, etc., and we might end up buying some sort of value trap, etc., in those fallen markets. So I think normal markets are good for my style of framework.
Moving on to some fund specific questions now. Having joined Kotak Mahindra Mutual Fund just 3 months ago, are there any changes or adjustments that you're considering for the portfolios of Kotak Emerging Equities and the Equity Hybrid Fund?
Yeah, so I would say if you look at the portfolios, which the way they were managed by my predecessor, I think the style or framework to a large extent is actually very similar. I would say to the extent of 80-90% of the portfolio, the style is very similar. I think what I can do is basically, because of the valuations in certain part of the market and certain domestic facing sectors or stocks have done very well, by which the portfolio has actually gained in last 2 years. In some of those cases, I am looking to book profits partially, not in one go, because the valuations are getting really stretched. And these are not the businesses where we can keep on extrapolating the earning growth or the top line growth. These are cyclical businesses to some extent. So while I'm booking profits in some part of the portfolio which is domestic facing, I am deploying that money into some of the sectors which had actually gone through a lot of time correction of maybe last 2-3 years, or some price correction as well, to the extent of maybe 20%. Sectors like pharmaceuticals, or some IT companies, or even some hospital stocks I'm adding to the portfolio, because that is one structural theme I can see can happen or can roll out in India over next 5-10 years. So I would say the changes are actually marginal, not drastic changes in the portfolio, but as an as per the market demands in terms of valuation changes, etc., or the business cycle changing, the changes will keep on happening. Apart from this normal sort of actions, what I'm also looking at is basically introducing some 10-15% sort of portfolio with some tactical ideas to suit the changing economy or the business environment. So we have seen that a good traction has come back in sectors like power, railway, uh, uh, or infrastructure side, and to some extent the portfolio was lacking some of these ideas. While last decade from 2010 to 20 these sectors have not worked, but they have made a comeback after 21-22, and I have sort of added some ideas from this power, infrastructure, or oil and gas space into the portfolio. These are not great businesses, I agree, the way I want to buy, but their time has come. They are sort of reasonable quality of balance sheet, and they are available at very good valuation with 2-3% kind of dividend yield support. So those kind of 10-15% of tactical ideas I have introduced in the portfolio. And apart from that, as I mentioned, normal profit booking and deploying into some of the neglected sector for last maybe 1 year, 2 year. That's where I'm adding in the portfolio.
Atul, if we look at the Kotak Emerging Fund, you are too much, the top 10 stocks are mostly into the materials and the industrial sector. So what's the strategic focus behind, investing in these sectors?
Yeah, you're right actually in that observation that if you look at the top 10 stocks, they are in a way a play on the capex recovery, which is happening and about to continue, I think. And these are stocks mostly related to power or explosive or indirect way to play those sectors related to infra. And I think all these stocks, if you look at, they have done very well in last 2 years. These are early cycle play in infrastructure, and they have played their role. And actually, they are trading at sort of on the higher side of valuation now, which I sort of explained in earlier answer that I'm looking to trim positions into those stocks. I think they have played their role, and though these are very good high quality franchise, high quality businesses and products, but I think it is very difficult to keep extrapolating the top line and the earning growth in these kind of businesses. These are cyclical businesses, even though they are very high quality, and hence we have to take those actions in terms of trimming at least partially into those kind of holdings.
All right. So the performance of Kotak Emerging Equity Fund has seen some challenges in 2023. So what other steps are you planning to take, to enhance its returns?
Okay. So first of all, about the performance itself, I think if you look at the 1 year return in absolute terms, I think it's pretty decent. I mean, investors would not have anticipated this kind of return in 1 year, as well as 3 year, 5 year return. CAGR is also very decent. Obviously, the fund has underperformed the benchmark and also underperformed some of the peers. But I would say that is largely because of the framework the fund has followed or is following for last few years in terms of orientations toward having good quality businesses run by good management, and hence they if you look at actually the beta of the fund is pretty low. It is 0.77 or 0.8. So I would say the risk adjusted return are actually very good. And what we have missed in terms of upside is basically just because of not participating into the some part of the market where there is sort of a lot of momentum chasing has happened, even when the fundamental improvement is not that great. The stocks have gone up on basis of just narratives or stories, and maybe a lot of investors chasing those stocks. But I think we will continue with this kind of philosophy because, as I explained, when the things turn or the market takes a turn, these kind of things can unravel pretty fast, and the drawdowns can be sort of huge. And I think going forward, as I mentioned, the strategy will continue, and the alpha is generated in two ways. One, by participating in the upside in a decent way, which I think we have done in a pretty good way. And obviously, the other part is reducing the downside or restricting the downside drawdowns when the market takes a turn. I think we are equally well positioned if the market sort of goes into a volatile phase, and some of these stocks which has done exceptionally well in last 2 years on the basis of narratives or stories, if they come down, actually our fund ranking can automatically come up. So I need not take any serious actions just from the perspective of bridging this underperformance, because if I start taking that approach, I'm sure I will make mistakes. So I don't want to get into that game. I think things will automatically pan out, and as if we start, I mean, if we keep following the framework and discipline and stay patient, I think things will automatically improve.
Atul, in the earlier questions you mentioned about the high PE stocks, and you like, investing into the high PE stocks, giving high multiples. But what are the risk while investing in high PE stocks? We have seen, they can remain underperforming for quite a long period of time, and because you hold so many stocks which are high PE in nature. So, what's your view on that?
Yeah. So Chirag, I just want to correct yourself that I don't like high PE stock.
Oh.
I like good business and good management, and invariably they are high PE. So my starting point is management and business, and not valuation. So yeah. So obviously, when we buy those kind of stocks, obviously multiples are very high, and I would say to buy a 40 or 50 PE stock needs lot more in-depth research, study, channel checks, and conviction than buying a 10-15 PE stock, because I can buy a 10-15 PE stock saying that it's reasonably valued, attractively valued. But when I buy 40-50 PE stock, I have to doubly sure that the business is good, can continue its run, and the management won't make any serious mistake. So I think that conviction, we need to develop conviction while buying those kind of stocks. And the way these stocks make money is actually, we have a lot of examples in last 10, 15, 20 years, the way these stocks have delivered return, including our bank and HDFC Bank, or those kind of examples I can throw at you, that those stocks have always sort of traded at higher valuation, but just by not making any mistakes and continue to deliver that 15-20% earning growth, these stocks have delivered this kind of returns over a long period of time. And actually, if you look at my portfolio also, historically also earlier organization, my portfolio churn has been around 15-20%. That means average holding period is around 5 to 6 years. And in within that 5 to 6 years, some of the stocks are actually held for more than 8-10 years to capture this kind of compounding which the companies offer us. So I think at starting point, the valuation might appear very high, but I think by not falling in the trap, and by continuing with the compounding these companies offer, one can make good money with lesser risk.
Atul, just wanted to understand one thing. If you are investing in this kind of stocks, and for example, suppose 2 year, 3 year down the line, you see a situation when earnings are not growing, then how do you deal in that situation?
Yeah. So obviously, when I say I want to ride these stocks and want to sit tight with these stocks, it's not that I will be completely sort of away from the valuations and fundamentals. As I said, the portfolio turnover ratio is 15-20%. That means I'm churning to the extent of 15%, 15-20%. So at within this core part also 70-80%, where the good businesses and all, there also some points will come where I have to book profits, and I will not be hesitant to book profits at those point of time. Like I mentioned in when you asked the question about top 10 holdings, I clearly mentioned that I am looking to book profits in some of those holdings, because whenever there is a sort of trinity in terms of good top line growth, very good margins, and obviously when the top line growth is good, margins are high, market extrapolate and assign very high PE. So high growth, high margins, high PE. I think in such cases, one has to take the money off the table, because you are not leaving any scope for disappointment at any point of time. So I think in such cases, I will obviously will not hesitate to book profit, at least partially, if I'm not exiting the stock fully. So I think it's not that I will just buy the stock and close my eyes and sit with it for years. So we do track the companies very actively, and also keep an eye on what's happening on the valuations and the economics part of it.
All right, now Atul, the mid and small cap sectors have been performing remarkably well recently. So, do you believe this momentum is sustainable?
Yeah, I think if you look at the Indian economy, actually is doing very well. I actually say to a lot of investors that in Hindi, if you call it, अपनी economy wise अपनी पांचों उंगलियां घी में है. Our fiscal deficit, current account deficit is very well controlled or coming down, and because of that, interest rate, inflation, and currency are very stable. And I think mid and small companies can do very well when they get this kind of stable environment as well as growth, because whenever currency and interest rate fluctuate, they have to deal with that situation. Large companies can manage very easily, but mid cap and small cap companies find it very difficult, and a lot of their efforts and time can go into it. But when they are getting stability, and on the other hand they are getting growth, actually they can sort of focus on businesses and deliver on top line and bottom line growth. And that's what I think was happening for last 3-4 years. And I don't see any reason why this should break, given the policies and reforms which sort of were undertaken in last 5 years or so. So I think economy is getting better and better, and it will obviously offer many opportunity to many corporates, including mid and small cap. So all these things are moving in good right direction. The only thing is on the valuation side, in some part of mid and small cap, there is actually some sort of, I would say, froth built up because of narratives and momentum chasing. And apart from general mid and small cap also, I would say valuations are on the higher side compared to history or even compared to large cap. And as we are going into or going through election season, and we'll have results, and then we have budget. Also in November, we'll have US sort of elections. So a lot of events are there. And apart from that, there can be any unknown sort of risk for which the valuations are not offering any sort of margin of safety. So hence, though I think fundamentally we are, positions very well, the valuation only makes us a little uncomfortable. But I think whatever that correction may be, I think it will be maybe short-lived in nature, maybe 2-3 months kind of volatility. But one should be mentally ready for those kind of things, I would say.
Atul, if we look at the mid and small cap stocks, it's challenging to uncover the value in this segment. So, given the current scenario, where are you finding the value in the mid cap and the small cap segment?
I think you're right. By and large, it is difficult to sort of get value in mid and small cap space unless you want to take some contrarian calls, maybe ahead of time. So as I mentioned, IT sector is going through a lot of pain now. If you would have seen this quarter results, none of the IT company has delivered actually any good number, and the commentary is also very sort of bearish from the managements. So, but if you look at from the other side, most of these companies are very good in terms of cash flow conversion, and they are offering almost 3 to 3.5% dividend yield now at this kind of valuations. And we know that beyond a point, their clients cannot sort of stop spending on IT or keep on deferring the IT spend. So I think, and this time even the US corporates are not leveraged. They are in good financial health. They are just postponing the IT spend because of the macro concerns. So I think at some point of time, those spends can come back and IT companies can start getting the growth back. And while all other aspects of the profit and loss and balance sheet are very intact. Relative valuations are also very attractive for the IT sector. But the only thing is we might be ahead of that point, maybe by 2 quarters or 3 quarters. Already 6 quarters of pain has been sort of taken by these companies, maybe 2 quarters more. But I think that is kind of space one can get value because we have seen these companies always make a comeback. I would say even certain specialty chemical companies have also gone through a lot of low phase of their business in last 2-3 years, mainly because of destocking globally. Because during COVID or after COVID, the global corporates actually stocked up the inventory because of supply chain disruption, etc. But now they're going through a destocking phase. Hopefully, maybe after 1 or 2 quarters, that phase will also get over because we are into 5th or 6th quarter of that. all these specialty chemical companies are invested heavily into product portfolio as well as capacity expansion. So that will also pan out over a period of time. So I think the value is in this kind of sector, which are sort of nobody is loving at this point of time. These are sort of contrarian sort of calls, and maybe 2 quarters ahead of the demand recovery. So I would say if you look at with deeply, there are spaces where one can deploy money. Just that we have to be patient when those sectors make a comeback.
Right now, before we wrap this up, one more question. Over your extensive career in investing, what market trends or events have taken you by surprise, and how have they influenced your approach to investing?
So actually, I mean, so though I was not managing money during 2008 crisis, but I had seen that very closely because I was analyst during that time and supporting the fund managers. And I think during those time, as well as during COVID, when the market sort of Nifty went down from down to almost 7,000-8,000, people were saying that time that it will go to 6,000. So I think during those crisis times, it is very important to keep calm and take a longer term picture and start sort of taking plunge into the market. I think market is all about managing the cycles of greed and fear, as I mentioned, while managing the promoters or sort of evaluating the managements and the promoters. I look at how they have managed the greed and fear cycle. I think that same rule applies to fund managers also, how they manage the greed and fear cycles of market. And I think that is very important to sort of start thinking contra when the market starts going into extreme on the both ends. While like right now, I think we are going in the extreme on the bullish side, and during COVID, we are sort of going extreme on the bearish side. So I think one has to find balance during those kind of extreme and start taking some kind of contrarian moves, which obviously helps over a period of next 2-3 years.
All right, with that, time for us to wrap up this chat for today. I'm sure our viewers will benefit from the insights that you've shared. Thank you, Atul, for joining us answering these queries.
Thank you. Thanks.